For so many Canadians, saving for a home, it really feels like you're running a race you just can't win. The market keeps moving, and that goal of a 20% down payment can feel like it's getting further and further away. It really brings up a tough question that a lot of us are wrestling with right now.
So, what's the right move? Do you jump into the market now with just 5% down, hoping to build wealth before prices climb even higher? Or is that just a trap that ends up costing you a lot more in the long run? Well, there's no easy answer here. It's all about trade-offs, and that's exactly what we're going to break down today.
All right, here's our plan. We'll start with the promise of that 5% down payment. Then, we'll get into the nuts and bolts of how insured mortgages actually work here in Canada. We'll look at a really interesting multi-unit strategy, weigh the gains, understand the sacrifices, and then get to the real bottom line.
Okay, first up, the 5% down payment promise. Look, the appeal here is pretty straightforward, right? It's all about getting into the market faster. It's sold as the quickest way to stop renting and start building your own equity without that long wait to save up 20%.
And this really gets to the heart of the matter. It's a classic dilemma. On one hand, you can wait it out, try to save up that full 20%, but you're constantly worried that house prices are climbing faster than you can possibly save. Or you can jump in now with just 5%, but you have to accept that it's going to come with higher costs. It really is a trade-off between time and money.
So, to really understand this strategy, we have to talk about insured mortgages. In Canada, it's simple. If you put down less than 20%, you are required to have mortgage default insurance. And let's be crystal clear about something. This insurance protects the bank, not you if you can't make your payments. The whole system is run by a pretty strict set of federal rules. Okay, so how is that minimum down payment actually calculated? Well, it's a tiered system. You need 5% for the first $500,000 of the home's price. Then, for any amount above that, you need 10%. And it's worth noting, as of the 2024 federal budget, this now applies to homes up to $1.5 million, which opens the door for more people in expensive markets like Toronto and Vancouver.
Now, this insurance isn't free, not by a long shot. You, the borrower, have to pay a one-time premium. And that premium usually falls somewhere between 2.8 and 4.0% of your total mortgage. It's a sliding scale, so the less you put down, the higher that insurance premium is going to be.
And here is a really critical piece of the puzzle. Most of the time, that insurance premium gets rolled right into your mortgage loan. Think about that for a second. It means you're not just paying it off, you're paying interest on it for the next 25 years. That adds a significant amount to your total borrowing cost over the life of the loan. Okay, so now that we know the rules, let's talk about how some savvy buyers use them to their advantage. This brings us to the multi-unit strategy. The idea here is to use that low down payment option to buy a property that generates income, like a duplex or a triplex. Real estate coach Paul D'Abruzzo puts it this way. The goal isn't necessarily to buy your forever home right out of the gate. It's about using that 5 or 10% down to get an income property that you can also live in. See, by living in one of the units, you meet the rules for an insured mortgage, and then your tenant helps you pay the whole thing off. It's a powerful concept. Let's make this real with some numbers. Say your mortgage is $2,800 a month on a single-family home. Well, that's your bill, all of it. Now imagine it's a duplex with the exact same mortgage. If your tenant is paying you $2,000 in rent, suddenly your personal housing cost drops to just $800. That's a massive difference in your monthly cash flow. All right, so let's talk about the upside. What are the real financial gains here? Because it's not just about getting into the market sooner, there are some other key benefits that come with an insured mortgage. There are really 3 big advantages. First, obviously, is faster market access. You're in. Second, and this might surprise you, you can often get a better interest rate. Why? Because the loan is insured, it's less risky for the lender, so they're willing to offer a more competitive rate. And third, you hold on to your cash. You're not tying up every last dollar in a down payment, so you have liquidity for emergencies or other investments. This also brings up the power of leverage. Let's say you buy a $300,000 property with $15,000 down. If the value goes up by just 1%, that's $3,000, your return on your cash is actually 20%. It's pretty amazing how leverage can amplify your gains. Of course, and this is critical, it works both ways. If the market goes down, your losses are amplified too. Here's something a lot of people don't know about. There's a hidden safety net built into some of these insured mortgages. Yes, the insurance is there to protect the lender, but some of the insurers also have programs to help you, the homeowner, if you hit a rough patch, like losing your job. And this is a real thing. For instance, the insurer Sagen says its program has helped more than 63,000 Canadian families keep their homes, and they have a success rate of over 90%. That's a level of protection you just don't get with a conventional uninsured mortgage.
But, of course, nothing is free. All of those benefits we just talked about, well, they come with some very real, very significant costs. And these are the sacrifices that you really need to understand before you even think about going down this path. So what are we talking about? 4 big ones. First, your monthly payments are higher. Simple math. Bigger loan, bigger payment. Second, you will pay a lot more in interest over the life of the loan. Third, you'll build equity much more slowly since so much of your early payments are just servicing interest. And finally, you have less flexibility. Insured mortgages have rules that can make it tougher to refinance later on.
So where does that leave us? What's the real bottom line here? The truth is, this is not a one-size-fits-all solution. Far from it. It's a calculated risk with very clear upsides and very clear downsides.
Ultimately, whether this strategy is viable or not comes down to your personal financial picture. You have to ask yourself the hard questions. Is my income stable? Do I plan on staying put for at least 5 years? And honestly, how comfortable am I with risk and with those higher monthly payments? Those are the things that really count.
In the end, just because you can qualify for a 5% down mortgage doesn't mean you automatically should. That's just the first hurdle. The real question you need to answer for yourself isn't, can I do this? It's, should I do this? And only you, after taking a hard look at your own situation and goals, can figure that out.